basis before. Previously, conducted by me, Shekhar, and Ruhan. Today, we'll pursue with that further. Today, we have me, Shekhar, and Kanishk to conduct this session. We'll be learning today candlesticks patterns and a brief about fundamental analysis in short term trading. I'll give you a recap about what we learned before. In the previous session, we covered trend lines, an intro about short-term trading, and what is short-term trading, how is it different from other kind of trading, and how is it different from long-term trading. And we also covered chart patterns, trend lines, and also support and resistance. So yeah, over to Kanishk.
Okay, guys. So I'll be continuing with the technical analysis. So in this session, we'll be discussing the candlestick pattern. As discussed in the earlier sessions, we covered the chart patterns, and now here we'll be discussing the candlestick patterns. So basic difference between a chart pattern and a candlestick pattern is that usually chart patterns are overall figures that are formed on a chart. Like it is a price action that like this is the price action. This is a double bottom pattern, and the candlestick patterns is usually consists of 2 to 3 candles. Like basic difference is that in a chart pattern there will be multiple candles, and in this candlestick pattern there will be 2 to 3 candles only. So there we'll be discussing these candlestick patterns, the bullish and the bearish ones. The bullish patterns include hammer, inverted hammer, bullish engulfing, and morning star. So let's discuss the hammer. The hammer is the candlestick pattern that is formed of a short body with a long lower shadow and is found at the bottom of a downtrend. The lower shadow must be at least twice the length of the body. Green hammers indicate a small bullish signal than red hammers. So basically, in as you can see here, this is hammer. So what is the significance of this pattern? Like there are multiple candles, multiple kind of candles formed here. So what different is in this pattern? So let's see. The there is a longer wick to the down and there is a short body. This indicates that the sellers tried to push the price down heavily, and but the liquidity was the buyer's interest was so high that they pushed it back, and that steep interest, like there was a liquidity pump into this stock, which indicates a bullish pattern. So this is a kind of hammer that is formed here. Let's see the hammer on the Nifty 50 chart. Wait just a sec. Okay, let's find it. Give me a second. Yeah, yeah. See here. Like it was consolidating, and after a short time, there was two hammers formed here. The sellers tried to push the price down, but the buyers propelled it back, forming a short body, and it formed for two consecutive. And after that, you can see the uptrend. See around 75% of return. It was in the August in September 2013. Give me a second. Okay, this is the example of the hammer. Like we know that these are the candlestick patterns, but we should not follow them like religiously. Like you should consider more factors too. Like if you see a hammer, then that doesn't mean that you have to buy it all the time. But and another implication and observation that I got from these candlestick patterns is that usually on a particular time frame, like this is a weekly time frame chart, and there are two candles formed. There is usually an underlying chart pattern on a lower time frame, which is also bullish. Like it can be a double bottom or an inverted head and shoulder. So let's see that on the daily chart as well. Like let's note the date. That's 19th of August of 2013. Now let's see the same chart on the daily time frame. 19th of August of 2013. Right. See, give me a second. Yeah, yeah. See, this is a clear double bottom pattern and a kind of inverted head and shoulder pattern. Like you can see that this is the lower shoulder, this is the first shoulder, this is the head, and this is the second shoulder. This indicates that the pattern is kind of bullish and which propelled it to an outstanding uptrend. Okay, now let's discuss the second candlestick pattern. Give me a second. The second one is inverted hammer. A less bullish pattern is viewed as an inverted hammer. The only difference between that, the upper shadow is long, at least the twice of the length of the body, while lower shadow is short. The inverted hammer suggests that buyers might soon have the control of the market, but it's not a very reliable position. Basically, it is a kind of pattern that is formed where that's the inverted hammer of the real hammer. And like, I won't consider it a very good pattern, but still it is in a textbook example, so you can consider it for a shorter term. Like, here I was looking at the weekly chart. You can consider it on hourly charts because you are going to trade in the Sikka for around 15 days time frame. So working on 4 hour charts would be a better choice here. Okay, now let's move to the next candlestick pattern. That's the bullish engulfing pattern. I guess bullish engulfing is kind of very accurate pattern in the market because usually when let's understand the theory of it first. The bullish engulfing pattern is formed of two candlesticks. The first candlestick is a short red body that is completely engulfed by the larger green candle. Though the second day opens lower than the first, the bullish market presents the pushes the price up, culminating in an obvious win for buy. So basically, a short bearish candle formed a day before, and after that day, it opened even lower, and after that the buyer pushed the price upwards because buyer got right price. Like, usually you want a good right price in the market, then only you enter, because like we call it timing the markets. Like, you need to find a good price to enter, because only then you can control your position. And like, if things go south, you have less probability of loss and you can manage your position sizing properly. So here, the this causes the buyers get the good prices, and after that the rally is propelled further. So let's see the example of bullish engulfing on the real chart. Just give me a second. Let's look. We are focusing on Nifty 50 chart, but it almost works everywhere. Like, I didn't have the time to find the examples here, so I'm using the Nifty chart. But still, it works almost in all the charts. Like, technical analysis is universal thing, so you can try it on all other stocks as well. So basically, here you can see that a bearish candle formed here, and after that a bigger candle engulfed it. Like, it didn't open lower. I'll find another example right now. After that the rally propelled, and here you can see the double bottom form, which is like, I told you earlier that you have to consider multiple factor while taking a position, not just only one factor. So here is a bullish engulfing as well, and a double bottom formation here. Like, here you can confirm that the double bottom is complete, and after its breakout you can take an entry. Okay, now let's try to find another example of the same. Give me a second. Wait. Yes, just a sec. I guess we can find it on a weekly time frame. Yeah, you can see this one. This has also engulfed the previous candle. Same happened here. Okay, so I guess these are the enough examples for the Nifty 50's bullish engulfing patterns. Like, yeah, see here, this one is also an example of bullish engulfing. Like, it is a very good pattern. It works almost every time. Like, because the buyers have took control, and there is also institutional buying done when such kind of a liquidity strike is happens. So this is the bullish engulfing pattern. Now let's move to the next one. Next one being the morning star pattern. Morning star is one of my favorite patterns because like it works very well in the market because it is a kind of an inverted head and shoulder pattern formation in a candlestick chart. Like in on a longer time frame, when you see this, and when you go to the shorter time frame, you can see an inverted head and shoulder pattern or like a double bottom like pattern. So let's discuss the morning stars theory first. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a three candlestick pattern, one short bodied candle between a long red and a long green candle. Traditionally, the star will have no overlap with the longer bodies, as the market gaps both on open and close. Now let's try to find this pattern on the Nifty chart. Okay, morning star. I guess Nifty has demonstrated a lot of examples of morning stars. Just let me find them. Okay. I think we can consider this a kind of morning star. Like these textbook examples and exact figures don't work in real life. Like you don't find the same thing. Like here are two candles, two mid candles, and after that the rally was propelled, and like we can see it here. Just give me a second. See, this is also kind of morning star pattern. There are just two candles, but still it worked. And see the rally after this. Like there is also a double bottom formation here, and after that the rally was propelled further. And now we can go to a shorter time frame as well. Give me a second. Yeah, this is also kind of like this is a long candle, and after that two short candles formed and a bullish candle formed, and after that the rally propelled. Like there are many examples of Morningstar pattern that occurs on Nifty and other stocks as well, and you can find them. So now let's go to the next pattern, the the hanging man pattern. Hanging man pattern basically it is a kind of hammer that is formed after an uptrend. Like the hammer pattern is a bullish pattern and this is a bearish pattern. So it indicates a trend reversal or a sideways consolidation. So basically, when a hanging man is formed at the top of the trend, then you can consider that it is turning bearish and you should be careful. So let's see the hanging man pattern. Hanging man is the bearish equivalent of a hammer. It has the same shape, but it forms at the end of the uptrend. Like the hammer, the lower shadow must be at least twice the length of the body. It indicates that there was a significant sell-off during the day, but that the buyers were able to push the price up again. The large sell-off is often seen as an indication that bulls are losing control of the market. Basically, in the bullish pattern, that was the hammer. We saw that the sellers tried to propel the price lower, and after that the bulls brought it up, the buyers brought it up, the liquid injection was done, and after that that is a bullish pattern that turned bullish. Here and the opposite thing is happening. Here the buyers were trying to bring the price up, but they couldn't, and after that the sellers took over. This indicates a bearish implication. So now let's go to the Nifty chart and see. I guess it was formed during COVID crash, if I'm not wrong. Wait just a second. See, this is a double top, and after that hanging man is formed here, and see the crash after that. Like This was one of the worst crashes. Like we implemented at 38%. And see, a perfect example of hanging man. Let's find, see this one also. This is also kind of a hammer that is formed after an uptrend. That's the hanging man. And see the downfall after this. And see the same thing, hammer has formed here, and another one is another hammer here. And this is also a morning star kind of pattern which propel the rally further. Now let's go to our next pattern, the shooting star pattern. The shooting star is same as the shape of the inverted hammer, but this is formed in an uptrend. It has the small lower body and lower upper shadow, which must be at least twice the length of the body. Usually, market will gap slightly higher on the opening and rally, an intraday high before closing at the price just above the open, like a star falling to the ground. Basically, it is a kind of inverted hammer pattern that is formed after an uptrend. See, the buyers tried to propel the price up, but the sellers brought it down, and a small body formed, which is a kind of a bearish implication because the sellers, this is a kind of a supply zone, and the institutions have sold there, and the liquidity is gone, and after that the price plummets. Now let's find the inverted hammer here. See, this is an example of inverted hammer on Nifty chart. Just a second. See this one, the same example as in the figure. And give me a second. See this one too. It worked. It even predicted before this hammer formation. Like, see, this is a kind of inverted hammer. This is also an inverted hammer, and this indicates that the buyers aren't able to take control. Okay. Now let's go to the bearish engulfing. Like we discussed in the bullish engulfing pattern, the next candle engulfs the previous candle. Like that's the bullish candle in the bullish engulfing. And here in this case, that's the bearish candle, the red candle that engulfs a bullish candle. So a bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by the subsequent long red candle. It signifies a peak of slowdown of price movements and is a gain of a sign of an impended market downturn. The lower the second candle goes, the more significant the trend reversal is likely to be. Okay, now let's go to our charts and see it. Guys, are you understanding? Like you aren't reacting at all. Give me a reaction, thumbs up, something. Nice. Okay. Now let's see the bearish engulfing pattern. Give me a second. See the perfect example of a bearish engulfing pattern. Although it was a bearish candle, but it still doesn't matter because it engulfed the previous candle and the price was in an uptrend. Like a it was the last rally of the market, and after the it was I guess it was a 2021 slowdown. Yeah, the market was rallying like crazy after the COVID crash, and after that, like it had to find a consolidation zone. So this was the last leg, and after this, a bearish engulfing candle formed, and you can see that for the 2 years, for around 1 year, the market was in downtrend, and it was basically like I would call it a consolidation zone, and we can look it as a mild downtrend, but still it was a slowdown, and the market was corrected around 17% from there. So bearish engulfing is a pattern that you should look at a while. Like see this one. This is a classic example of bearish engulfing. See, the previous candle is bullish, the next bearish candle is formed. After that, there was a breakdown, and see the COVID crash. I guess it is enough for the bearish engulfing pattern. Now let's move to our next pattern. That's the evening star pattern. The evening star pattern is a three candlestick pattern that is equivalent of the bullish morning star. It is formed of the short candle sandwich between the long green candle and the long red candlestick. It indicates the reversal of an uptrend and is particularly strong when the third candlestick erases the gains of the first candle. So we looked into the morning star pattern. It had like you can see the morning star pattern here. This is exactly opposite of that. Just a second. Yeah, this is exactly opposite of that pattern. So now let's find it on the Nifty chart. I guess it was formed on recently. Give me a second. Just give me a second. Yeah, yeah. This is an example of evening star pattern. This one. This is also an example of evening star pattern. Just the two candles are formed before, but still it counts. Like there are no textbook examples available, as I showed, as I explained earlier. See, this one can also be considered as an evening star pattern, but it just corrected a little bit. This one is also an evening star pattern. This corrected the trend. Like there are multiple patterns formed. Like you won't get a perfect crash in a pattern. Usually there are big patterns formed on the large time frame that indicate a long term correction. Like this is a short term trend, and that short term trend has reversed here. That's we would call it the downtrend for this trend, but for an overall trend, it is a correction. So basically, it is a very subjective point of view. The what time frame are you considering, and what factors are you looking in? So here it is a correction. Like, and now let's go to another pattern. Give me a second. Here, this one is also kind of no. Now we won't consider this. Just a second. I guess there are. This is enough for now. Now let's go to the. Give me a second. Okay, now I'll hand over to Shikhar. He'll be continuing with the fundamental analysis. Shikhar, you can continue.
Yeah. Thank you, Ganesh. That was some great insights on candlestick patterns. I hope you guys have gained something out of it. So I'll just share my screen. Yeah. So now we'll talk about fundamental analysis for a while. So, as previously discussed, we had discussed technical analysis for short term trading. So, many new traders, many aspiring traders think that for short term trading, only technical analysis is needed and they pay less attention to fundamental analysis, which is uh, somewhat true in practical basis, but not always. So, in technical analysis, of course, in short term trading, your goal is to make profits quickly. So, you don't care about how the company is doing, how the business is doing. So, but how? Why do you need fundamental analysis? So, there are about, I guess, there are about 5,500 plus stocks in the BSC and about 4,500 together in the NSE and BSC. So how do you select out of those, out of that lot? That is a difficult task. So you screen out the stocks which are fundamentally good. Now, why do you need fundamental analysis? First of all, what is fundamental analysis and how is it different from technical? So, technical analysis in, I'll just explain it simply. It is just an analysis of how the stock price is doing. And fundamental analysis is, if we put into simple words, that means it is basically analyzing how the business or how the company is doing. That is why fundamental analysis is important, because in the end, it's a company, it's the business you're buying and selling. That has to be legitimate, or else one bad news comes out of it and the whole stock goes crashing, despite the indicators, despite the good patterns, and despite the good technicals of the stock. So, what do you have in fundamental analysis? You analyze the annual reports. What is annual reports? The company's annual reports consist of how the management is doing, how the business is doing, was the sales. It consists of three financial statements, as we have learned in our 12th grade, which includes cash flow statement, balance sheet, P&L statement. So, reading annual reports includes reading those financial reports as well. Also, annual reports mention the financial health, potential growth, and how is the industry and how's the company doing. More in fundamental analysis, you view the company news. How's the company doing in the news in the markets? What is the sentiments around the stock? So yeah, again, let's talk about Hindenburg. So obviously, when Hindenburg news comes about any stock, it goes, everyone shorts it and it goes crashing, as we have heard about it. Company news matters a lot. Industry trends. If a sector is not going good, then how can a company do good? Again, that is important in fundamental analysis. Next, we have an important concept of in short-term trading called risk management. So I still remember we got a question that if there are so many theories available, so many theoretical concepts available about short-term trading, then why do most of the traders lose money? That is because of the discipline and because of the risk management. They don't follow a plan, and they don't set up a risk management plan of how much they can lose, to how much they can gain. So that is very important. You have to look for yourself about how much capital you can put. Uh, and in risk management, we have 3 points. Setting stop loss orders is one of the most important point in short-term trading. As in long-term investing, you can always average out your position. That is a different concept. But in short-term trading, when your goal is to make profits, you're also at risk, so it can also go downwards. So you have to set a stop loss. How do you set a stop loss? Again, you look at the indicators, you look at the charts. A great method of setting a stop loss is to study about the resistance and support, as talked in a previous session, that can indicate a good stop loss orders. So again, for short-term trading, when considering swing trading, 5 to 7% of stop loss is recommended. Again, it depends upon your personal choice. It's just a bookish recommendation. Position sizing is another thing in risk management. So there is a 2% rule in swing trading. When you buy and sell securities within a few days, that is what swing trading is. So there is a rule. There is a 2% rule. Again, this is a theoretical rule. It does not mean that you have to apply it to yourself. That depends totally upon you and your risk taking ability. But again, the 2% rule says that do not risk more than 2% of your whole capital in one trade. So suppose you have 1 lakh rupees. So this rule says that do not risk more than 2,000 rupees in just one trade. Diversification. Again, I think you guys have heard the famous saying that do not put all your eggs in one basket. What does it mean? That is basically diversification. So you must spread your investments, and you must spread your positions across different sectors, different companies. And a good diversification strategy in short-term trading would be to not put more than 5% of your capital in one company. So yeah, that is what diversification is. It is required that in case a few stocks go downwards and go wrong side, you still have a backup, and a few stocks can cover you out. That is why we need diversification. We need diversification everywhere in short term investing and also in long term investing. So how do you do these stuff practically? Again, you need tools and resources, and there are many available. There are many available to learn. There are many available to use. You can today they have advanced brokers like Zerodha and Upstocks, which provide trading platforms for you. They also provide advanced charting tools and features. A few trading platforms also provide strategies, and they also give stock recommendations as well. So, utilizing their technical analysis features would be a viable option for you, as these are readily available with the brokers. Stock screeners is a good example of how you can filter out. It is a good tool of how you can filter out stocks. As I have told that there are many stocks in the NSE and BSC, more than 4,500 in combined in both of the exchanges. How do you filter them out? You of course choose some filters like return on equity. We have studied ratio analysis in our class 12th accounts. So you take the most important resources the most important ratio, like return on equity is a well opted one. It's Warren Buffett's favorite, by the way, return on equity. And you can also choose profit growth, and also you can filter out compounded annual growth rate. I'll also give you a short example of screener later. Again, we have the third thing, we have financial news websites available for our tools and resources. There are many websites and many news channels available today: ET Now, Money Control, ET Markets, the website of ET Markets. If you have to trade in the US markets and in the global markets, you can use the Wall Street Journal, FT, Financial Times. So these are some tools and resources available for you to make your trading easy. I'll give you a quick example of screener. So if you have to screen out stocks, you can use. There are many websites available, many tools available, and there are also paid softwares. I'll use a website called Ticker Tape today, and I'll also give you a brief example about screener. That is the most opted one. One second. Yeah, so this is how a typical stock screener looks like. How do you filter out stocks? You apply filters. Suppose I have to find the best stocks from Nifty 50. Or let's not take Nifty 50. We have used it in many examples. Let's take a sector. The defense sector was doing very well lately. So we'll take the defense sector today. Uh, and then we'll reset this. So suppose we have to take a filter of return on equity. First, we'll take compounded annual growth rate. We'll check how the stock has performed over 5 years. It's like this. That's return on equity. I think that's enough. Also, in Ticker Tape is also a good website if you have to analyze a stock. It shows most of the fundamentals and technicals for free. So first we have a company named Hindustan Aeronautics, Bharat Dynamics. Here we have a list. It has shown Hindustan Aeronautics has shown the most compounded annual growth rate return, about 63%, and followed by Bharat Dynamics at 44%, with a huge return on equity. This is a great ROE for any stock or any company, which is about 28%, followed by Bharat Dynamics at 17%. That's how you screen out stocks. Let's take another example. Let us take automobile, or let us take IT, information technology. Yep. Now we set the 5-year growth rate at let's take a minimum of 15%. That is quite good for the stock markets, and a high of 30%. Yeah, and a return on equity of we'll filter this out. Let's keep the upper limit of at 30% and again the minimum limit at 15%. So here we have our stocks, guys. First, we have HCL Technologies. Now, see, it has filtered out the TCS, Infosys, as we have put filters on it. So HCL Technologies comes at the highest level at a 5-year growth rate of 26%, which is a great growth rate, and return on equity on 23%, followed by Mindtree at 25%. That is how you filter out stocks. So that is the main role of screener. Okay, I'll go to the PPT again. So I hope you guys have understood the importance to screener and how it can be used to easy for easy trading. These were the tools and resources available to make your trading easy and simple. Now, these all things are useless if you don't follow a trading plan. So again, most of the if you ask any successful trader or any successful investor, they'll always say that have a trading plan and stick to it. Even I suggest that having a trading plan is important. It doesn't matter that what is your trading plan and how is it, but sticking to your plan is more important than developing a trading plan. So, discipline and sticking to a trading plan is the most important part in short-term trading, and that also depends upon your trading psychology. And now, how do you make a trading plan? I'll just explain you shortly. First of all, you determine your goals. What is your goals? How much profit do you want? How much money do you want to make? And by what time do you want to make it? Do you want to day trade? Do you want to make a 10% return in 3 months, which is a lot, by the way? Do you want to make a 25% return in 6 months? That is always up to you. So that is how first you determine your goals. Then you, after defining your goals, you choose how much time you can commit to trading, and that is how you match your goals and how much time you can commit to trading. And then after that, you set a risk to reward ratio. What is a risk to reward ratio? Suppose we have a 1:3 ratio. That means I can risk 100 rupees in order to gain 300 rupees. That means I'm risking. That means I can lose 100, but I am always expecting it to triple. That is a risk to reward ratio. Favorable ratio in swing trading is always 1:3 or 1:2, depends upon your personal goals. I would say a 1:3 risk to reward ratio is quite recommendable. Then after setting a risk to reward ratio and developing your plan, what indicators you must use, what patterns you must use, again that is upon your personal choice. We have talked about many indicators such as RSI, moving average. That is your personal choice, guys, or whatever you want to do and whatever suits you the best. Then after this, after developing a trading plan, you must keep a trading journal. You must record what decisions you took and how they came out. Was it good? Will Did the indicator work? When you suppose you're trading on news basis, so does it result the same way every time or not? So you must keep a trading journal. You must record your mistakes. You must analyze, and then according to that, keep developing your trading plan and keep changing it. So that was all about developing a trading plan. That's all for today, guys. That's all for this session. I hope you have gained some valuable information from this session conducted by us. Uh, So yeah, now I would like to hand over to Kanishk to conclude this session and take the Q&A.
Okay, guys, now let's wrap up this session. So, basically, short term trading involves buying and selling securities within a short time frame, ranging from a few minutes to few weeks, taking the market factors, events, and indicators into consideration. Basically, for a short term, like the short term definition can be a very subjective thing. For you, a short term definition should range from a week to a month. Like you have to hold that stock for at least a week, and like if you get a good return in within a week, then you can sell it, but don't buy it from a perspective of say buying it for a week. And don't do intraday. For like having an intraday perspective is not a good thing in the market, and usually 90% of the traders lose money in the option trading or the intraday trading that they do. So while now the second one, while technical analysis is usually preferred in short-term trading, fundamental analysis of security is also necessary. So why is it necessary? Like for suppose you buy a stock for holding it for a month, like month, your trading plan ranges for a month, and the things go south when the market goes south, and you don't and the your position is you have like your stock goes down 5 to 10% and your position is like blown off. So now what gives you the confidence to hold the stock? If the company is fundamentally bad, you buy a penny stock hoping that it will go on freezes and you'll just earn the easy money, then it won't work, because as soon as the overall market sentiment is disturbed, these stocks, these short penny stocks which do not have any intrinsic values, are the worst hit. So you must consider that you buy a fundamentally sound company while trading. Like my approach is like that. First, I look at the chart. If the chart is good, I'll go to the fundamentals of the company, because I want that confidence that what I'm buying is actually the value I'm getting. So keep in mind this. I would like you to keep this in mind. And in short-term trading, success hinges on discipline, rational decision making, and the risk management. Hence, developing a trading plan according to your needs and sticking to it is the most suitable way to improve your performance. Basically, discipline is the key. Whether you want to achieve anything in your life, discipline is the key. Like many of the people become disheartened by short losses in the short term, and they, because they look market like a way to make easy money, and there is no easy money. And like if you see someone earning a lot, like with his luck, he'll be most likely to end up losing the money in the long term. Why do we say that market has delivered a 10 to 15% CAGR? This is the reason, because no one can outperform the overall market. Like if you are holding something, you'll end up losing. Like if you are 70% up, but you don't know what you have bought, you don't know when to get out, then in the end, in the long run, you'll just end up losing money, and you'll even end up losing the principal amount. Okay. And now the continuous learning and adoption are essential for success, enabling individuals to stay informed, innovate, and effectively respond to the changes, thereby fostering resilience and growth in the dynamic environment. Basically, markets are dynamic, the businesses are dynamic, everything is changing every day. So you guys must do not stick to a particular strategy that you think that, because you have confirmed that and you have a particular data on the basis of you are making decision, and you are just stubborn that if that the you don't consider the changes in the market. If you thought, like, if you screened a stock using ROE, you'd see that the ROE is good, but that overall sector is declining, and there is a particular negative news like crude oil prices is up, and your particular company that is affected by it is affected for a short term, and it can even range for a longer term because of a reduced profitability. Like your paint industry requires the crude oil for as the raw material, and if that goes up, then it can be affected. But the companies are growing good, and the Asian Paints is doing good. But in the long term, you will just end up risking your money. So you have to change your decisions and trail your stop losses. Like we know that what a stop loss is to avoid the loss. But as soon as your trend go as soon as your stock moves upwards, then you have to bring up your stop losses, and by like you have to trail your stop losses according to the changing market conditions. So that is it for today. I'm opening up the floor for the questions. You guys can ask, and if you have any doubt. Yes, Puramjot.
Will this PDF be provided in the group about all those candlestick patterns and other things?
Yes, yes, we'll share it. Yeah, Ronak.
Kanish bhaiya, so we know that you have taught us well, but I want a live demonstration of what exactly the two sessions that FIS has conducted. Like, how do we process it in real life scenario? Like, how do we select a stock actually?
Okay. So for selecting a stock, I would recommend you to go for Nifty 500 stocks on the NSC. Like I can share the screen. Can you remove the screen shaker? Just give me a second. Okay. Now let's go to the NSC website. See, this is the Nifty 500 stocks list. Like you, I'll send it on the group as well. Give me a second, yeah. Okay, so this is the issue with Safari. When you'll download it from Chrome, you will get the CSV file right away. So basically, these are the stocks list of the top 500 market capitalization based companies in the India. So I would recommend you to screen it on the trading view first. First, check like use the each name and screen it like this. Like just a second, go on trading view and put each name, try to find the patterns. If there is an underlying pattern that is formed, then you can you look into the fundamentals as we taught, and on the basis of that you can make a trading decision. Am I clear?
Okay, bhaiya.
Okay. Anyone else? Yeah, Prakar.
Okay, so first of all, I'm not into stocks or anything. So I just thought that since we've heard about technical analysis, we've heard about fundamental analysis, is it practical to say one is better than the other one from a beginner perspective?
See, Prakar, we can't conclude that a particular analysis or a particular thesis is better than other, because every pattern every analysis and thesis works in a particular dimension. Like what is technical analysis? Basically it is the study of the price patterns that is formed, that is plotted on a time series chart. That in that we plot candlestick charts, and there are multiple patterns formed that tell us what is going to happen in the future. Basically it is used to find the right price to buy, because using the fundamental analysis you can't find a right price to buy. Because even if you calculate the intrinsic value and you try, you see you use that, like I if the intrinsic value is 20 and the stock is trading at 100, and then, like you won't get that price. That's because intrinsic value is based on a lot of assumption, and that is very subjective. So you have to rely on technical analysis for that. But you can't conclude the whether company is doing well, or whether it is just a price manipulation by just looking at stocks. Sorry, just looking at the chart. So you need the fundamental analysis to study how the company is actually performing, and whether that rally is the profitability fueled, or just a liquidity injected through by manipulation by the big players. So both are you need both to make an informed decisions.
Okay, thank you.
Yeah. Okay, next one is from Raghav. Can you check the pattern on ITC chart? Okay, give me a second. ITC, right? See, in ITC, we witnessed a double bottom here when it was the COVID crash, and then it hovered around for 200 rupees. Yeah, remember that we used to make the joke of the ITC that it is trading at 200, 200, 200. So that was the consolidation actually, and that was a really positive thing. And I don't know why people made it a negative way to make fun of a stock, but it was a good consolidation, as you can see here. Double bottom has formed here, and higher highs, higher lows, and after that the rally was propelled. Now I think what can happen. See, the first head is formed. I think there can be a formation. I am not predicting anything, and like I need to conduct more analysis on this. But according to my observation here, and according to my observation in all the stocks that I have recently been screening, and the Nifty's pattern, usually there is a lot of formation of the in this inverted head and shoulder pattern. So I think if the inverted head and shoulder pattern like this is completed, then the stock can go even up. And like we can check it here. See, these are the moving averages, and I think around 448 can be the low. And if it consolidates here, then it can go up. But still, it is further away from the 200-day moving average, which is a bit concerning for me. So I won't consider it as a good buy. And a double top can also be formed here. Like if this and if it breaks this low, then a double top can be formed. And if this neckline breaks, then the stock's price can go down. So like it is a kind of dicey place to buy. Any next question? I hope your doubt is clear, Raghav.
Yes.
Okay, bhai. Anyone? Sanya, right? Okay.
Okay, so Ganesh, my question is related to Sikka actually. So
Okay.
since that Sikka is a 1 month project, so do you think that fundamental analysis would be beneficial for me considering if I have to, if I have in my mind that I have to win Sikka, or I should mostly focus upon technical analysis?
Okay. I think you have like you can rely more on technical here, but you have to keep fundamentals in mind. Like I can demonstrate this with an example. Give me a minute. Okay. Let's go to the screener and see the value traps, and that I think that will clear your doubt. Just a minute. I think SPIN is good. Yeah. Now see, I think this will happen in future. I'll demonstrate it with a prior example. Let's take RPG Life or yeah, RPG Life. Okay. Uh, Now see, at this stock has a consistent earning growth with a oscillating P ratio around its median. So now if you want to trade in RPG Life, like I found this trade a long back. I don't know. Yeah, here. Yeah, this is the consolidation, and I found out. I predicted that it will go up. Like I added it on my LinkedIn as well, and after that it showed a good rally. So now how can I conclude this? Like it can be a stage four formation, and this trend can also break down. So have to check the fundamentals, that if whether if any value trap is not forming on the stock, like the PE ratio is consistent with a good earnings growth. So this rally, the rally that the stock has shown since its low in 2020 is kind of fundamentally driven, and the stock is performing well according is fairly priced according to the fundamentals. So that's why I thought that this trend is going to continue further. And see, you can see that this is like a month, around a month or a two. Yeah, it can be done on 15 to 20 days time frame. This was this kind of trade. And I also checked the ROE and ROC, the DuPont analysis. Everything was fine. So like you can get like a good satisfaction that the company that you have invested in or you are trading is a good one, and it will not fall that much during the market. Like the market has corrected a lot, but the stock is still is in a good uptrend, and see the downfall is not that much. Like I can show you a very good stocks like LTF, LNT Finance, and see the downfall in this one. So that's why you have to consider the fundamentals as well. I hope your doubt is clear.
Yeah, understood, Ganesh. Thank you.
Anyone else?
Kanish, we have a question from Shashank that what is your view on ONGC?
Give me a second, I'll check it. See, in ONGC, I think, just let me check. Yeah, the for ONGC, I would say that the 200-day moving average is broken, and the stock has also formed a kind of an head and shoulder pattern. Like if it consolidates here and then breaks down, then it can be a bearish thing to do. But still, it is in a good uptrend, and if it crosses 280 around this 280, then it can also reverse the trend. But still, it is a dicey place to buy. Like I wouldn't consider it as a good investment here, because I prefer more consolidating stocks near the moving averages, and that's the case here. Now let's also check the Fibonacci areas. Like see, you can see that a kind of an inverted, a kind of a head and shoulder is forming. The same is happening on the Nifty too. I can show it to you. Just give me a second. See, this was the existing inverted in head and shoulder pattern that was broken down, and now another one is forming. And if it goes like this and breaks down, then there can be a major crash happen. Like I'm not predicting a crash, but according to my conviction, this can happen if it fails to cross this level. Like if it crosses this level, then we can see a new bull trend. But if it fails to do so and this breakdown happens, then this can be a risk. So same thing is happening on the ONGC right now. And now let's check the fundamentals too. If technicals are bound to fail, then we can look at the fundamentals too. ONGC. Yeah. Yeah, on fundamental point of view, the company is good. It is below the median PE levels. Earnings are good. So I think a bit consolidation can happen, but can't predict an exact thing until the dust settles. I hope it is clear how much capital one should have for option selling. Natik, for option selling, you require a good margin, because like in option selling, you have an unlimited loss potential. Basically, there is a limited profit and unlimited loss position. So in case you start losing money, your position goes south, then you can incur heavy losses. So usually the brokers keep a high margin requirement in the case of an option selling. Okay, Shashank, but in coming month, crude oil prices will shoot up. So don't you think it will help ONGC? Yeah, it can help ONGC. Like let's check the crude chart as well. See, see the crude chart is in a heavy consolidation zone, and yeah, it is like I don't think that in very near term that the crude oil prices can go up, because this is a very heavy consolidation zone, and it will take a lot of time to break out of it. So as soon as in that the meanwhile the ONGC will also set its valuations, and after that the rally can propel. Anything else, Shashank? Okay. Netik, is your doubt clear? Netik? Okay, anyone else having any other doubt? Or should we end this session? नो डाउट्स गाइस, रिएक्ट तो कर दो कुछ. चलो ठीक है फिर. Okay, guys, thanks for joining us, and I wish you all the best for the upcoming project Sikka. Brush up your financial skills, and we'll see you in the ring. Okay.
Thank you, guys. Thank you for joining.